to share with you the 4 questions that these private equity firms have when evaluating your practice to buy it. Hey there, Rafi with Rehab U Practice Solutions here. And this week on the podcast, I want to talk with you specifically about a couple conversations I've had with private equity firms or PE firms that are looking at buying private healthcare practices. And I'm going to share with you the 4 questions that these private equity firms have when evaluating your practice to buy it. All right, let's jump right in. So I will admit right off the bat that I am not a mergers and acquisitions consultant in the healthcare space. The only reason I feel like I ever get pulled into these conversations with private equity firms or organizations looking at acquiring healthcare practices is because they're looking at evaluating the business itself from a strategic standpoint. Maybe they're looking at what can be exploited, what are quick ways to get some ROI, does this business look like a viable business long term? But I don't get pulled in on like, okay, this is how you do the deal and this is what it would look like. I don't do any of that. If you have questions about that or you're looking at getting your practice ready to sell and you want some to have a conversation with somebody that does this all day, every day, Mike Pekatowski, he's been on the show a couple times, is a great resource. I'll link to his information in the show notes, both on YouTube and in the show notes on the website for the Better Outcomes show, and follow up with him and just, say, I'm looking at selling my business. What do I need to do to get ready? This is really just going to be a conversation about a few questions that have been asked recently by some of the PE firms that I've talked to about specific businesses in the physical medicine space and whether or not, they were evaluating whether or not to invest some or large portion of some revenue into the business. So a couple of these were PE firms that were looking at not acquiring the entire business, but a part of their business, of this business, and then some were looking at purchasing outright. But the questions were relatively similar, and they've changed over the years. So like I said, I'm not a mergers and acquisitions consultant, so I don't get involved in these questions all the time. I've probably had maybe, I don't know, half a dozen conversations with PE firms over the last, 12 months or so. So not very, very regularly at all. But it's been enough for me to see a change in the trend. So what I'm going to do is I'm going to share with you the 4 questions, the 3 questions and then a bonus one that usually gets added on at the end. And then I'll kind of break down each one and kind of the way I see it and what it means for you as a practice owner if you're looking at potentially selling part or all of your business. So the first question was, given XYZ Clinic's particular strategy for growth, what are the risks in the event of an economic downturn? The second question is, what potential changes in the healthcare landscape over the next 12 to 24 months could impact revenue at this clinic? Particularly, the follow-up questions in this series of questions revolved around payer mix, fee schedule or contracted rates and the ability to negotiate, and then patient volume or pipeline of patients. And then the third main question was, given the current economic environment, so again, we're talking, this is 2023, so this question probably changes depending on where the economy goes over the next little bit, but given the current economic environment and the state of the physical medicine space, is it wise to consider investing in an organization or investing in a clinic or practice with the end goal of developing additional clinic sites at this time? So again, this is a very much, you talk about like evergreen questions or something like that. This question is probably one of those ones that changes over time depending on where we're at. Obviously, interest rates have gone up. It's more expensive to borrow money and take out a loan or something like that to invest in this. So this is one of those things that people these firms want to know about. Is it a wise decision to invest some capital that we might be paying interest on with the express purpose of expanding either geographic footprint or space itself or something like that? And then the bonus question that's usually followed up with all these conversations is, let's say this investment gets approved and we decide to buy part or all of this practice. What areas of this practice are being either underutilized or inefficient or have the potential to deliver a quick ROI or return on investment or value add by implementing a few simple operational or process improvements. So let's kind of break that down from the beginning. Now, obviously, the answer to these questions is going to depend a lot on your specific geographic location, your region, your market, the details of your practice and your strategy. Like, are you looking at the majority of your caseload, for example, being Medicare patients versus workman's comp, and kind of the intricacies of those two different markets and service spaces. But we'll kind of dive in and explore it a little bit. The thing that has struck me in all of these conversations recently that I've had, so I've had, like I said, half a dozen, 6 or 7 or so over the last year. Early on, maybe a year ago, the questions still revolved around kind of what are the inefficiencies, what can we do to get a quick ROI. But the last 3 that I've had, which have been over the last month and a half, so December to January of 2023, has been really focused, these conversations have been really focused on downward risk mitigation. So what are the risks here? What can we do to protect ourselves in the event that we were to buy this clinic or this practice and then something happens, the economy tanks or their sources of referrals dry up, whatever it is. But there's been a whole lot more focus recently, at least in the conversations that I've had, which again is not hundreds and hundreds, but it's a handful, about this idea of downward risk mitigation. So it seemed like every time I finished answering a question, particularly about the conversation that I had just 2 days ago with a PE firm, maybe I was answering a question they had about this particular practice or just stating a fact that I noticed about this practice, the follow-up question was always something along the lines of, what's the risk there? Or, does that make this practice vulnerable to XYZ, you name it, a meteor, whatever the risk is, they had questions about it. Now, perhaps that's because the practice in and of itself that we were talking about specifically had a lot of locations. It was a larger practice. It had more than 10 locations, which meant that it was going to be a larger investment, a bigger buy, if you would. So obviously, you're looking at all the variables, and if you're investing a whole lot more money, it becomes more behoove you to do your due diligence before you even kind of progress down that path. Or maybe it's the fact that this is the way that private equity firms normally go about evaluating investments in the healthcare practice, right, or a healthcare space. I'll admit I'm not an M&A advisor, and I only get involved with these types of discussions to the extent of providing insight into the operations, the business development strategy, or the clinical process of care at these practices for the express purpose of improvement post-investment, right? So again, I've only talked to about half a dozen or so in the last year, 6 or 7 in the last year. But there does seem to have been a shift in the last few conversations, like I mentioned, to that of this downward risk mitigation. Now, I'm going to reference again Mike Pekatowski. He's been on the show a couple times, but he does a monthly, it's a market update specifically for the physical therapy space, but it kind of rounds out all the public acquisitions that have occurred in the physical therapy space. And one of the things that has been very interesting to me to see over the last 6 or 7 months following him and following these reports that he puts out is that the shift has very much moved to like small 1-2 location clinics and practices being gobbled up. And then there's a big gap between that and like 8+ clinics. It's the clinics that or the practices that have 1 or 2 locations are making up the majority. I think last month it was like in the 40s percentage-wise of the acquisitions. And then there's single digits all the way up until you get to the 8+, and then it kind of jumps back up to like 25% or something like that. So what that tells me is that the people that are buying healthcare practices these days, the way I would interpret this, they're making small bets on maybe safer bets or bets that don't require a whole lot of financing, so they're not having to pay interest on it. So maybe there's smaller acquisitions that can be done in cash, and that also have a very low bottom side risk or downside risk. And they're looking for these organizations that maybe are smaller practices that are run inefficiently, and because of either their back office or their operations or things that they see in the practice that are inefficient, they can kind of move in and do a very quick turnaround, if you would, get some quick return on investment and have this practice now, part of their portfolio. And then obviously once you get into the bigger practices, there's other things, economies of scale and stuff like that. So let me circle back to these 4 questions, and I'll just kind of give you my thoughts on what I would do if I was in a position where I was looking at maybe selling a practice and I wanted to kind of shore it up, make it attractive to one of these maybe private equity firms or buyers. So that first question is, what are the inherent risks given this particular practice's growth strategy? So for example, if your growth strategy, if the business model is we're focusing 100% on Medicare patients, or that age range, maybe Medicare and Medicare Advantage, we're building some of those commercial insurances, but that's the demographic that we serve, and that's going to be our strategy for growth. If I was in the position of shopping around my practice and trying to get it purchased, what I would want to do is, in the way that I'm presenting it, I would want to make it very clear that I've taken a look at the risks given this business model, and that I have mitigation strategies in place already, or on the docket. I would want to be able to say, okay, listen, I know that 90% of our practice is Medicare, which means the big risk there would be regulatory changes, or CMS decides that they're just not going to pay, or whatever it is. They're going to cut the fee schedule and all the things that happen when CMS decides they're going to screw something up, right? And I would want to have things in place so that the potential buyer could look at it and not just see the risk, but say, okay, this practice owner or this practice manager has the pieces in place, or at least they're aware of the potential risk, which might make them a little bit more at ease. The second question about what potential changes over the healthcare landscape over the next 12 to 14 months, 12 to 24 months could impact revenue, I would want to be very solid on payer mix. I want to have all of that data, let's say for the last year or more. One of the things that we do at our practice, and if you're interested in this, shoot me over an email at rafi@rehabupracticesolutions.com, and I can share with you some of what we've done at the practice that I run. But I have a dashboard, and over a year, basically, what I do is I track the previous 10 EOBs from all of our major payers that we're seeing. If they're outliers, they don't really count. And then it's all in a dashboard, both what we get reimbursed by the insurance company or the payer, and then what is the patient responsibility. It goes up at the top, and there's a weighted averaging system so that we can put in, okay, 20% is Blue Cross Blue Shield, 30% is Medicare, 40% is Humana, whatever they are, and it weights each of those total compensation. So it averages these, what is the patient responsibility, what we get paid by the insurance. It gets averaged into a fee for service, or this is what we get paid per visit for this insurance company. And then on the side, it does a weighted average based off the percentage of claims that we submit to each of those payers. And then at the very bottom, it tells us this is your weighted cost per visit or revenue per visit. So what I can do is I can turn back the clock for the last 12 months and say, our cost per visit has gone up or it's gone down, and it's gone up or gone down because something has shifted in our payer mix, either intentionally or unintentionally, and these are the steps we can do to change it. So I highly recommend tracking your actual cost per visit, as opposed to even if you're doing a pro forma or something like that, because it's going to give you more of a real time, and it's going to put whoever's potentially purchasing your practice at ease, because they're going to say, okay, he's got the data, he knows what's going on, and he's tracking it. And again, many practices that I've talked to just don't. They might have an idea of their payer mix, but they really don't have an understanding of how that payer mix is affecting their weighted average or their actual revenue per visit. So being able to document that, show that in hard data, can be very reassuring for somebody that's going to purchase your business or looking at purchasing your practice. But it also gives you a lot of leverage too, because then you can begin changing those things. You can look at your data and say, okay, we're getting 70% of our income is coming from this payer that pays us very, very low. What can we do to either reduce the number of claims we're sending out to that payer, or increase, and it's probably gonna be a little bit of both, increase these other payers that are paying us at a higher rate, right? The other thing would be, fee schedule, contracted rates for smaller private practices, maybe in the 1 to 10 clinics or something like that, it's hard to negotiate higher rates a lot of cases. Like Blue Cross Blue Shield is not going to sit down. I own a practice myself. They're not going to sit down with me and negotiate over because I've got one practice that's seeing, 6 or 7,000 patients a year. They're not going to negotiate with that. So you want to be aware of it, and you want, again, I would want to have like a spreadsheet of the payers and the contracted rates and when those things come up for renewal and all that kind of stuff. But unless you're a super big practice, you're not going to have a whole lot of leverage in negotiating fee schedules. But what you can do is just say, listen, this payer dropped down below what was profitable for us, so we cut them. We're tracking that. There's a great book. I'm looking for it right now. I think it's called Islands of Profit in a Sea of Red Ink. And the whole point of the book is like, you can look at a business that is profitable, but if you dig down into the different components of that business, you can see there are some businesses that are aspects of that business that are super overperforming, right? They're providing all of the margin of the profit of the business. And then you have some areas of this business that are like anchors or sales. They're like, they're dragging down everything. And if you were to cut those out, you could really improve the performance of the business. So it's the same thing with payers. Like your payer mix is one of those areas where I would look at and say, listen, we are losing money on XYZ insurance company. We either need to cut them out completely or we need to reduce them so that it becomes profitable for us, right? There's things you can do about like scheduling and how you treat and all that. Not that you ever dictate care by the way you're being reimbursed, but it doesn't do you any good to run a business that's going to go out of business because you're unprofitable, right? Okay, moving on. So the third question that I've been getting asked recently on these conversations really has to do with the idea of expansion, and is it wise to expand given this current economic climate? Now, given where we're at now in 2023 at the very beginning, interest rates are still up there. They're not low like they were a couple years ago, and money's getting tight. People are tightening up their belt, so to speak. This is one of those questions that changes over time, right? And it probably changes on your location as well. So for example, in the city that I'm operating in, we have four big hospitals, four big hospital systems. Three of them are for-profit, and one of them up until recently was nonprofit, and now they just got purchased by a big healthcare system that's going to move in, and I'm assuming going to start gobbling up all kinds of stuff. In that event, it depends on what your strategy is. If your goal is to kind of flip this around and sell it soon, it might make sense to add a couple locations in the event that you could do it in a way that is going to be profitable in the short term too. Because again, Mike Pikatowski can tell you a little bit more about this, but you don't want to add a location then try to sell your business the next year. That's not good. But if your plan is to sell in 3, 4, 5 years, it might make sense to look at adding a clinic or two now, so that you can bring up the valuation of your business. That being said, if you're just looking at holding steady, maybe you'd consider an acquisition offer if it was on the table. I would want to look at, again, your side, your downward risk of opening up a clinic. That brings more overhead. It brings more cost in doing it, investment in capital. It ties up capital, especially if you're buying a location and building it out and all of that. Same thing could be said for expanding into a bigger space. So given personally, my feeling is where we're at, where interest rates are at, unless there was a clear ROI, like very clear, we could turn this around pretty quickly. I don't know if I would be adding a location simply to say that we've added locations or to potentially capitalize on a market. I would want to make sure that we've done the market research, that we know that we can do it and be profitable from day 1 or day 30 at the latest, and be able to kind of see the roadmap there and how it fits into our overall strategy of selling the business, if that's the plan, or just growing our footprint and becoming more of a stable thing over time. So again, that's going to be one of those questions that kind of shifts. Maybe in 6 months, interest rates are negative, and then it doesn't make sense. I don't know. But currently where we're at, I don't think I would be investing in adding locations unless there was a clear path to profitability for that location in the next 30 days, right? Okay. The final question, the bonus question, if you would, that gets asked is, let's say this investment gets approved. What are the areas of the practice that are underutilized or inefficient that we can turn around very quickly to make an ROI? What this tells me as a practice owner and someone that advises private practice owners in this space is that what you need to be doing, or what you need to do every couple weeks, every month, is you need to have your own KPIs that you're looking at and noticing areas in the practice that are inefficient, and look at it very, very objectively, because that is going to be the way that you make more value or make more or add to your valuation in the event of a sale. Because what these, especially PE firms and stuff like that, what they're looking at is a way to make a quick ROI, and they're going to undercut or discount the price in the event of finding something that's a huge inefficiency. So, Jerry Durham talks about this a lot, but like patient engagement and retention and all of that plays a huge role. If if a firm can look at your organization and say, you know what, 5 or 6 out of every 10 patients that come into this practice don't complete their course of care, they drop off the schedule, we never hear from them again. That's a huge inefficiency that if we can capitalize on, we don't have to do any extra marketing or advertisement, and we can bring up the profitability of the business. The same thing can be said for you as the business owner. You need to look at the areas of your practice that are bleeding money, right? That sea of red ink, and look at how you can shore those up. Because in the event of maybe you do get approached to be acquired or whatnot, you want to be able to make sure that you've plugged all the holes and you've maximized the potential value that you can capitalize or realize in the event of a sale. So anyways, that's my thoughts on the subject, and that's all I've got for today. So if you like the show, head on over to iTunes, leave us a rating and review. If you're watching this on YouTube, hit that subscribe button, hit the bell notification button, and you can get dinged or pinged or whatever happens whenever we upload a new video. And if you own a private healthcare practice, primarily in the physical medicine space, and you're looking for a system to attract, acquire, engage, and retain more patients, more clients, boost your revenue, boost your margins, reach out to me, rehabuppracticesolutions.com. I'd love to have a conversation with you and see if it makes sense for us to do something together. So until the next time, be safe, be healthy. I will talk to you then.